The government says the economy added barely any jobs last month. That's after revising January down to basically nothing. Think about that for a second. Almost no new jobs for the entire United States of America. In a month, that's like one decent-sized company doing a modest hiring spree. Meanwhile, January layoffs just hit levels we haven't seen since the financial crisis. Consumer confidence is in free fall. People are pulling back spending. Credit card delinquencies are spiking to levels that should terrify bank executives. And yet GDP is still growing. Inflation is supposedly coming down. The stock market is flirting with all-time highs. The Fed is talking about soft landings. So which one is real, the official data that says everything's fine or the reality on the ground that says everything's broken? What's up, guys? It's Tom here, and I think we need to talk about what a hidden recession actually looks like, because I'm pretty sure we're living through one right now. If you've been following this channel, you know we've been tracking something the mainstream completely missed. Back in November, we built a recession scoring model tracking dozens of economic indicators, everything from initial jobless claims to consumer credit conditions to yield curve dynamics. And while everyone was celebrating those supposedly strong job numbers, patting themselves on the back about the resilient labor market, we flagged that the data looked completely fake. The methodology was off. The seasonal adjustments were suspicious. The revisions were getting bigger and bigger. Turned out we were right. The Bureau of Labor Statistics just admitted they overcounted jobs by hundreds of thousands last year. Phantom jobs that never existed. We called Bitcoin's crash before it dropped hard from its highs. While crypto influencers were screaming about moonshots, we were warning about leverage unwinding and regulatory pressure. The defensive portfolio we've been running has quietly outperformed the S&P while taking significantly less risk, and now the recession model is flashing 67 out of 100. That's officially pre-recession phase, up from 62 just 5 days ago. The trend is accelerating. So let me break down what's actually happening here, because there's this massive, almost surreal disconnect between what the official data says and what people are actually experiencing in their daily lives. And that disconnect, that's not an accident. That's not a statistical quirk. That's how modern recessions start. They don't announce themselves with a stock market crash and unemployment spiking overnight, like in the movies. They start quietly, insidiously, with hiring freezes instead of mass layoffs, with companies cutting hours instead of cutting people entirely, with consumers slowly, gradually pulling back instead of panic, selling everything they own. The technical term economists love to use for this is a soft landing. Sounds nice, right? Gentle, controlled. But here's what nobody's telling you. Historically, most attempted soft landings aren't landings at all. They're just slower crashes. It's like trying to land a plane with failing engines. Sometimes you make it to the runway, usually you don't. The Fed has tried this maneuver many times since World War II. They've succeeded maybe a few times depending on how you define success. Let's start with jobs, because this is where the hidden recession shows up first, before it hits the headlines, before it shows up in GDP numbers. The headline number was pathetically low jobs added in February. That sounds terrible, right? Because it is terrible. You need a lot more jobs per month just to keep up with population growth. Young people graduating college, people re-entering the workforce, immigrants. The economy needs to create jobs for all of them just to stay even, so barely any new jobs. That's not growth. That's stall speed. That's the economic equivalent of a plane barely maintaining altitude. And that comes after they revised January down to almost nothing. Almost nothing. I keep coming back to this because it's so absurd. For context, Amazon alone typically hires more people than that in a single week during normal times. The 3-month average is now completely anemic. Compare that to last year when we were supposedly seeing strong growth before we found out those numbers were largely fiction. And here's the truly scary part. January layoffs just hit the highest level since 2009. Companies aren't just not hiring, they're starting to actively cut. But because it's happening gradually, through attrition and hiring freezes, rather than dramatic pink slip days, it doesn't trigger the media alarm bells, it doesn't make for good TV, but it's just as real. Now let's talk about consumers, because this is where you actually feel it in your wallet, in your daily decisions, in the way you think about spending money. People are pulling back spending, not because they want to, because they have to. Credit card debt is at record levels. The average American household is carrying thousands in credit card debt at interest rates approaching 30%. Delinquencies are climbing steadily. Banks are starting to tighten lending standards. And here's the thing about consumer spending. It's most of the entire economy. When consumers tap out, everything else follows like dominoes, but the pullback is gradual, which makes it dangerous. It's death by 1,000 cuts. Instead of buying a new car, you keep driving the old one for another year. Instead of going out to dinner twice a week, you go once. Instead of taking that vacation to Europe, you stay home and maybe do a road trip. Instead of buying name brand groceries, you switch to store brands. Each individual decision feels small, rational, responsible even. But multiply it by millions of households and suddenly retailers are missing their earnings targets. Restaurants are seeing traffic drop month over month. Airlines are quietly cutting routes. Hotels are offering steeper discounts. The recession spreads through the economy like a slow-moving virus, invisible until the symptoms become undeniable. So why does GDP keep growing if all this is happening? Why do the official numbers look okay while everything feels broken? Because GDP is fundamentally a lagging indicator. It measures what already happened months ago, not what's happening right now, and certainly not what's about to happen. Think of it like your car's rearview mirror. It tells you where you've been, not where you're going. And there are technical reasons GDP can stay positive even when the economy is actually contracting in real terms. Government spending counts toward GDP. If the federal government is spending money on infrastructure or defense contracts or just basic operations, that boosts the number regardless of whether it's productive or sustainable. Inventory builds count too. If companies made a bunch of stuff that's now sitting in warehouses because nobody's buying it, gathering dust, that still counts as economic activity in the quarter it was produced. But here's what GDP doesn't capture: the quality of that growth. Is it sustainable? Are people actually better off? Can they afford their rent? Can they buy groceries without stress? GDP doesn't care about any of that. It just adds up the transactions. It's like measuring the health of a person by only looking at their height. Sure, it's a data point, but it tells you almost nothing about whether they're actually healthy. And this is exactly what the recession model is picking up on. It's not waiting for GDP to turn negative or unemployment to spike dramatically or the stock market to crash. It's tracking the leading indicators. The stuff that breaks first, the canaries in the coal mine, the yield curve just uninverted, which sounds good until you realize the spreads are still extremely tight. That suggests a soft landing is theoretically possible, but the margin for error is razor thin. One policy mistake and we're right back to inversion. The Conference Board's leading economic index is weakening consistently. Months in a row of declines, that's not a fluke, that's a trend. Unemployment is creeping higher, not crashing. That would actually be easier to deal with. Instead, it's creeping steadily upward. Continuing claims are softening too. That's the number of people staying on unemployment benefits longer because they can't find new jobs. It's climbing steadily. Initial claims are bouncing around, but the trend is starting to move up. These aren't dramatic moves that make headlines, but they're all moving in the same direction down. And when you put them all together, when you weight them properly and track the momentum, you get a score of 67 out of 100, pre-recession phase, the highest it's been since we started tracking. And here's where it gets really interesting from a policy perspective. The Federal Reserve is completely trapped. They've been cutting rates, trying to engineer that famous soft landing everyone talks about, but inflation is still above their 2% target. Not by much, we're talking slightly above target, depending on which measure you use, but enough to make them nervous, enough to give the inflation hawks on the committee ammunition. Jerome Powell is trying to thread an impossible needle. Now they've got this jobs data that's clearly weakening, clearly showing cracks in the labor market, but they can't cut rates aggressively because that might reignite inflation expectations. Remember, inflation is fundamentally psychological. If people think prices are going to rise, they start buying now, which actually causes prices to rise. It's a self-fulfilling prophecy. But they also can't raise rates or even pause too long because that would finish off what's left of the labor market. So they're stuck trying to cut just enough to keep the economy alive, but not so much that prices start spiking again. The problem is that needle keeps getting smaller, the window keeps getting narrower, and historically when the Fed tries to thread this kind of needle during an economic slowdown, they miss most of the time. The soft landing success rate is not encouraging. So there are really three ways this plays out from here. Path one, the best case scenario, the one everyone's hoping for, is the Fed actually nails it. They cut rates at exactly the right pace with exactly the right messaging. The labor market stabilizes around current levels. Companies stop cutting but don't start aggressive hiring either. Consumers adjust to higher prices but don't completely pull back from spending. They trade down from steakhouses to casual dining, but they don't stop going out entirely. GDP growth slows but stays positive. Markets muddle through with modest volatility. That's the soft landing everyone's hoping for. I'd put the odds at maybe a quarter. Path two, the more likely cases, we get a garden variety mild recession. Unemployment rises to historically normal levels. GDP goes negative for 2 quarters, which is the technical definition. Markets drop moderately, which clears out some of the speculation but doesn't destroy wealth entirely. Corporate earnings fall, but profitable companies survive. People with jobs keep them, but everyone gets more cautious about spending. It's painful but manageable. It's 2001, not 2008. I'd put the odds at about 60%. Path 3 is where things get genuinely ugly. The jobs weakness accelerates into actual mass layoffs. Consumers stop spending entirely, hoarding cash for the storm. Corporate earnings don't just fall, they crater. The Fed has to choose between fighting inflation and fighting recession, and they choose wrong. Markets drop significantly. Unemployment climbs dramatically. Credit conditions tighten severely. That's a real recession, not a hidden one. That's 2008 territory. I'd put the odds lower, but the consequences would be severe. So what does this actually mean for your money, your job, your life? If you're in the stock market thinking you're properly diversified, let me give you a reality check. The biggest names, Microsoft, Apple, Amazon, Nvidia, Google, make up over a quarter of the entire S&P 500. Your diversified index fund is really a concentrated bet on big tech and the artificial intelligence boom, and those companies are not immune to a consumer recession. When businesses stop spending on cloud services and consumers stop buying iPhones, even the giants feel it. If you're thinking about buying a house, proceed with extreme caution. Affordability is already at historically extreme levels. The median mortgage payment is eating up nearly half of median household income. That's unsustainable. If we get a real recession, house prices could correct significantly, especially in overheated markets. But if you're waiting for mortgage rates to come way down, that might not happen if inflation stays sticky. You could be waiting a long time if you're carrying credit card debt. This is the absolute time to address it aggressively. Interest rates are averaging nearly 30% and rising. In a recession, credit gets tighter. The banks that are lending to you today at reasonable terms might not be tomorrow. Pay down that debt while you still have income and access to credit. And look, I get that this is heavy stuff. I know nobody wants to wake up and think about recession when they're trying to pay rent and put food on the table and maybe save a little bit for their kids' college fund. These aren't just numbers on a screen or academic exercises. These are people's lives, people's futures, people's ability to take care of their families. But ignoring what's happening doesn't make it go away. And being prepared isn't being pessimistic, it's being responsible. Bottom line. The recession model reads 67 out of 100 pre-recession phase. The score has moved up significantly in just the last week as job creation basically stalled out and market anxiety started to spike. The long-term forecast is showing elevated probability of recession by early 2027, up from last month. I remain defensively positioned, heavy cash allocation earning 5% in money market funds, significantly reduced equity exposure focused on quality dividend-paying stocks, minimal exposure to speculative assets, crypto or growth stocks trading at extreme valuations. That positioning has outperformed the market since we started tracking it, and I'm not changing course until we see real sustained strength in the labor market and consumer spending. If you want to track all this stuff in real time, see exactly how the model works and what data points are moving each week, I built a full dashboard at recessionistpro.com. All the indicators updated daily, the long-term recession forecast, sector analysis, the works. $20 a month, cancel anytime. Here's what to watch over the next few weeks. The March jobs report drops in early April. If the 3-month average stays pathetically low, that confirms we're in economic stall speed and the model jumps to 70. And watch the Fed meeting on March 18th carefully. If they pause rate cuts because of lingering inflation concerns while jobs data is this weak, that's the needle threading strategy failing in real time. The model hits 70 if both of those things happen. At 70, we're officially in recession warning territory.